There are only few months left until the end of 2020, and attention is now turning to how markets will close the year. For those who haven't had time to follow recent developments, the past few months have seen some unique, unexpected trends. Since its lowest point at the end of March, the US stock market has grown by around 52%. We have never seen such a high rate of growth in a bear market that technically lasted only a month, with the best August for US stocks since 1986. Frankly, even though we had predicted a rise back in March, we were not expecting to be in this position at this point in the year, given the complexity of the period we are in. The S&P 500 hit a new record in mid-August, about 6 months after hitting a peak on February 20th. To put this into context, the recovery after 2008 took over a year, and in the case of the dot-com bubble, we were still recovering 4 years on. There are a few things that have made this trend possible. First of all, central banks and governments flooded the market with liquidity, further depressing government bond yields and leaving operators very few alternatives. Imagine a pension fund that needs to shield themselves from inflation in the long run. Global businesses, and this is where we see the benefit of geographic diversification, have shown impressive strength and adaptability, which has manifested itself in more solid earnings than expected. Growth like this allows us to look to the remaining months of the year with hope of achieving a positive outcome also in 2020. Technology companies in particular have shown earning resilience that at least partially justify their increase in valuation. These stocks have been the primary driver of stock index performance since March, particularly in the US. But let's divert our attention away from the short term for a moment and focus on the long-term outlook. Interest rates on government bonds are at zero and could be like that for years, not to mention cash, which is being hit by historically low saving rates and the potential for growing inflation. The outlook for property looks bleak, given the reduction in residential income and especially commercial leasing. In short, financial markets look increasingly like a relatively safe option. For investors, the important thing to remember is that cash sitting in a bank account can lose purchasing power against inflation over time. If the past 6 months have shown us anything, is that markets can change quickly and are difficult to predict. Those who stayed on the outside, who have maybe chosen to disinvest in March, or have delayed their entry into the market because they were worried about a second drop, have missed a key opportunity to build their long-term wealth. However, they can make sure they don't miss another one. Markets remain unpredictable, and we can't be sure that they'll continue to grow, but we are not interested in giving short-term opinions. What we do remain confident in is that investing in the stock market with the guidance of an expert is and will always be the best way to grow one's wealth in the long term. Holding large sums in cash or trying to time the market have time and time again proven to be deeply problematic strategies. Latest data from June shows there is over £1.5 trillion sitting in UK bank accounts. This is an incredibly amount of money, which is at the mercy of inflation if it's left where it is. The next few years will be financially complex for all of us, so managing your wealth carefully is crucial, and if you have the chance, now is the time to reach out to an advisor to start planning with their guidance. I'm really positive that this will benefit long term your career and your wealth.